In fact, the proposed solutions do not in any way modify the existing financial mechanisms within the global economy. In fact, the architects of this G20 proposal are very much the same people who have been behind the neoliberal agenda for the last 20-odd years. The bailouts to the banks continue, but now what's happening, the IMF will be taking on a very important central role in channeling cash into real economies, or in fact,
real economy.
This would take
the perfect economy.
A number of governments. The amount allocated to the IMF, we're talking about really large amount of money, is $750 billion, and the reports will tell you that $750 billion is to be used to help the developing countries. It is to be used to alleviate poverty. It is to be used to ensure that these countries have a recovery. Now, we must understand, first of all, that most of these countries are already in the stranglehold of an unpayable foreign debt, external debt. There's no proposal to actually eliminate or cancel that debt. Quite the opposite. There is a proposal that the countries continue paying their debt, and that the IMF will enable them essentially to maintain their relationship with international creditors. How does it work? Well, essentially, the IMF will receive the $750 billion from the IMF members, and particularly the major shareholders of the IMF, which are the United States, Japan, Britain, France, and so on. And then they'll go to the countries, indebted countries of the third world, where for the last 30 years they've been applying structural adjustment programs, which is called strong economic management, and they will go and they will say, well, under this new facility of IMF, which is there to tackle the global financial crisis and its impact, we have here a $2 billion loan. And so this is a $2 billion loan. It's to help you face the vagaries of the recession, and then to restore some order in your economy. Now, this country is already heavily indebted, so that in effect, this country is already heavily indebted. It has debt servicing obligations of the order of $4 billion a year. And essentially what the IMF is doing is the following. It's lending $2 billion to the country, and then the country then has to pay back $4 billion to its external creditors. So give me back the $2 billion and you owe me another $2 billion. Essentially, this is what the IMF has been doing for the last 20-odd years, is lending money with a view to triggering their repayment. Essentially fictitious money. It's a paper operation. You lend new loans to pay back old debt, and then in return,
new loans to pay the old debt.
You have to implement a number of reforms so that you get your house in order, stabilization, and so on and so forth, so that your economy will recover. And then they will impose restructuring the public sector, austerity measures, privatization, and so on and so forth. This money, this new facility of $750 billion does not come without so-called conditionalities. It is money which is lent to the developed countries, and in return, they will then apply a further string of privatization measures. Bear in mind that these policies have been ongoing for quite a number of years, and essentially, I consider that this by expanding the role of the IMF, by giving it more power, more money, in effect, you are enabling the IMF to impose its economic medicine in increased fatal doses, so to speak, compared to previous periods in IMF money that comes in and goes out. It is not used to finance real economic and social development. The IMF does not have a mandate in that context, and the mechanisms that I've described show that, in effect, this is a safety net for the creditors. It's a way, it's very similar to the bailout, okay? You're giving money to the government, and the money of a developing country, and then the government of the developing country is handing it to the bank. So this, essentially, this money, this $750 billion, which is an enormous amount of money, is going into the pockets of Wall Street creditors. Exactly, that's what's happening. You lend to Brazil, okay? We will lend a portion of that amount to these countries, including those who are members of the G20, Indonesia, Brazil, the highly indebted countries. And then what happens? These countries then use this money to pay back their debt. They also have to put in some more money of their own, but at least it enables them to maintain the legitimacy of the debt servicing relationship. They're not declaring default. They're preventing these countries from declaring bankruptcy, and then the money goes back to the bank. Now, what have been the policies that should have been applied with a view to resolving the crisis? One, countries, developing countries, should cancel their foreign debt unilaterally. This is something which has been discussed for quite a number of years. These debts are owed to creditors. They were obtained in various circumstances. They had the stranglehold of their creditors. In other words, these debts should be cancelled. And that in itself would be the basis for recovery. Secondly, what you need are measures which will freeze derivative trade.
Freeze derivative trade.
In commodity markets.
Stop speculation.
Foreign exchange markets should be frozen. This is very important because ultimately that's the source of instability. Then we have to freeze the hedge funds. And then we have to take the money which is being handed to the banks, the bailout money, and channel it to the real economy. In other words, use it
real economy is perfect economy.
And so on.
Perfect economy
like the Obama administration
is the solution.
And many other countries, including
there is
Canada,
no other solution.
Several countries in Western Europe. Take that, instead of handing it to the banks, they can do what they want with this money. You use the money to, you inject the money into real projects which create employment, which uplift the economy, and which ultimately restores an element of sanity in the economic process.
Perfect economy
and thirdly, I think what's very important is the central bank has to be in the hands of its citizens. There has to be a process of democratization of monetary policy. In the United States, that means the nationalization of the Federal Reserve System, which is really a private bank. The Federal
nationalize the Fed and adopt mathematically perfect economy
Federal Reserve Bank
and jumpstart new economic expansion.
Nationalized, and the structure of monetary policy